Warner Brothers Discovery is truly a giant of the mass media industry. They have a number of iconic brands from the Discovery Channel, part of their namesake, to HBO, which has iconic drama series such as The Sopranos, The Wire, Oz, as well as Succession, and the great fantasy series Game of Thrones, and more recently House of the Dragon, or as I like to call it, Hot D. You know what I'm saying? So basically, they've got everything from Shark Week to My 600 Pound Life to Game of Thrones to Gold Rush Alaska, and really so many other things in between. I would have trouble even naming all of them. This company really stands toe-to-toe with some of the giants in the industry in terms of their content library, in my opinion. But just having a lot of great content, of course, does not necessarily make them a great business or a great investment. They've been getting a lot of coverage lately, and super investor Michael Burry, The Big Short. Now, I'm not saying he's a fat short person. What I'm saying is he's the guy from that movie, The Big Short. So he's the guy that's really known for kind of more or less calling it in the 2008-2009 bubble that we experienced in real estate. And, he made a lot of money there, I'm sure. And he's known as sort of an investing icon. He has a position in Warner Brothers Discovery. Does that mean that you should go out and buy Warner Brothers Discovery? Well, I think Michael Burry's approach to investing might be a little different from the average person. And just because it's right for him and, his, managed portfolio doesn't mean it's necessarily right for you. Now, they've had a dip as of lately, partly due to this writer's strike. It's really hit a lot of the media companies. I think Paramount also had a pullback because of it, in addition to other things. But year to date, Warner Brothers Discovery has actually performed quite well, at least price-wise. But the financials, in my opinion, are a little bit of a different story. So, when it comes to Warner Brothers Discovery, it has not existed in its current form for very long. The merger closed, I believe, in 2022, which is why we had revenue go from $3 billion to almost 10 in one quarter. Okay, this wasn't because they just are a great business that was growing revenue 200%. It's because basically that seems to be the first quarter where the combined financials of both Discovery and the Warner Brothers half that got spun off from AT&T started get reporting as one business. So basically, a couple years ago, AT&T announced that they were going to spin off the Time Warner part of their business, which included like HBO, Warner Brothers, yada yada, and merge it with Discovery, which was its own publicly traded company at the time. And in the process, also spin off about $40 billion of AT&T's substantial debt along with it. And so we don't really have much of a track record of what the combined business looks like. There's not really any normalized numbers yet at this point. So really what you have to go on is what they've done in the quarters since the merger, as well as, some analyst projections, any forward guidance from management, etc. Which brings me to the fact that, okay, so Everything Money recently did a video on this stock, and I wish they would have at least pointed out that a lot of their software, a lot of the metrics they use go off of 5-year numbers and averages. This hasn't existed for that long as it sits right now in the form that it is right now. So I would be very careful trying to take into consideration any 5 or 10-year numbers on this company, because that is going to be skewed in some ways. Now, that being said, it doesn't look all bad recently in terms of revenue, okay? The top line has been impacted somewhat, it would seem, because ad spend is down. They do have a lot of live TV on cable still. They've got, the Discovery Channel, TLC, and I think the History Channel as well falls under them. Correct me if I'm wrong on that, but those channels still get some of their money from ad revenue. The writers' strike, from what I understand, has possibly hurt them as well, though it probably isn't quite reflected in the last earnings release because it hasn't been going on long enough, I don't think, to have been reflected there. Yeah, you've got maybe some recent dilution. And the most concerning thing for me, actually, is the balance sheet. Now, hear me out. They've got, on the surface, what looks like a good book value per share at $18.65. But you see that it has decreased a bit in recent quarters. And still, though, you look at it, shareholders' equity, $45 billion with a market cap of $27 billion. So it would seem like they're a little undervalued on that metric. However, you got to be careful a little bit with that because goodwill and intangibles make up $100 billion of the assets on their balance sheet. What that means is that the tangible assets that they have are a much, much smaller portion, and they actually have, if you only look at the tangible book value, a negative tangible book value. Now, I don't want to necessarily discount all of their goodwill and intangibles because when you're in the media business, I think a lot of what you have isn't like a physical or tangible thing that you can just hold in your hands necessarily. So a lot of the value does come from, things that may be intangible. The brand, the brand name of a lot of different things, right? Like, I would say HBO, the brand name of HBO, comes with a lot of prestige to it, right? And I think it is hard to assign, a numerical cash value to something like that. Similar to, the name Disney, comes with a lot of prestige to it. I think WBD actually has the rights to Batman and Superman, if I'm not mistaken. Well, or at least the movie and TV rights, if I'm not mistaken. Those are some pretty big names. They come probably with a lot of value that would be hard to quantify. But investments are somewhat more about what you can quantify. So if you were to try to do some kind of evaluation model to figure out what it's worth, if you factor in the balance sheet and the tangible book value, it's in the whole $22 a share, partly because of the fact that their debt is it's gnarly. Okay, $44.2 billion in long-term debt. That's a scary number, I'm not going to lie. Especially considering that their net income is negative. Okay? And their free cash flow, fortunately, is not negative. It looks like it was $1.7 billion in the most recent quarter. But still, that's rough because it was negative the previous quarter, 2.4 billion the quarter before that, negative the quarter before that. And granted, like, this is a significant portion of the combined company's history. So what's the normal free cash flow? That's so hard to get from, the limited information we have. So in a lot of cases on a company like this, I think you have to more rely on the analysts' projections for the next couple years, because I think they're going to be really tuned in with what the forward guidance is for management. They're going to be asking questions on those earning calls. So I would look at what they think it's going to be. So they're sitting here saying EPS 35 cents in 2024, 92 in 2025, $1.54 in 2027. I mean, wow. If that all comes to fruition, I mean, that's not that great, to be honest with you. Like, let's go off the 2025 number and like round that up to $1. Okay, I'm not gonna dock them for the negative tangible book value. We'll start at the $1, 11% discount rate, and I'll give them credit for a little bit more growth from there. We'll maybe call it 6%, because they actually have it as much higher than 5%, at least for the couple years following 2025. So we'll be a little bit more generous, say 6% a year for 10. Okay, maybe, but that's like, this is not factoring in the debt at all, though, right? So I'm not really sure. Like, for me, I don't necessarily get how Michael Burry's getting here. I mean, maybe his estimate is higher than the average analyst estimate. Maybe he thinks that they'll get to this $1.50 mark sooner. Jeez, it's really hard for me to say. This is tough, though, because even if you do that, I mean, even if you do that and like really crank up the growth, like, even still, when you look at if you factor in the debt, it's still pretty rough. But maybe they'll pay down debt. Maybe they'll really focus on attacking it with whatever their cash flow is for the next few years, and maybe avoid having to refinance it at higher interest rates. But the fact is, man, like, it just seems like analysts don't see the earnings. I mean, and they see it as negative on the year still for 2023. I don't know. The track record, it's tough. It's tough. Yeah, I would have a hard time getting there on this one. Like, it might be. I mean, hey, Michael Burry's a smart guy. I'm not going to say that I'm better than him or anything. But, hey, Michael Burry's in this. Buffett is in Paramount, which I'm in. And, like, on the numbers, I have a much easier time wrapping my head around Paramount being a value today, more so than this. So that's why I'm in Paramount instead. But let me know in the comments below if you're interested in getting into Warner Brothers Discovery. If you're in any other of these mass media businesses, Disney, Netflix, Comcast, let me know which one you think is going to win the streaming wars. Is Netflix all the way? Is Disney coming for their lunch sometime soon? I love to hear from you. Join the Discord, link in the description. Consider becoming a member. Only like $0.05 a day, $1 a month. Actually, it's 99 cents because I'm cheap. like that. I don't like to necessarily exclude anybody because of charging too much. Also, I want to remind everybody that we have a live show, usually Saturday nights, every week on Cashflow Kings Live. Link will be in the description there. Co-hosted with my buddy at The Ryan Dengler Show at YouTube. Take it easy, everyone. Cheers.